Welcome to this LizBiz Academy Explainer. Look, today we're tackling something that could literally determine whether you keep your house or lose it to the IRS. We're going to unpack exactly why missing a payroll tax deposit is, without a doubt, the single most dangerous operational mistake you can make for your personal financial safety. It sounds intense, I know, but stick with me because by the end of our time together, you'll see exactly why managing this correctly is absolutely non-negotiable. So picture this scenario. It's the end of the month, cash flow is just a little tighter than you forecasted, and you see that chunk of change sitting in your account earmarked for payroll taxes. You might be thinking, hey, I'll just treat this tax deposit like a regular utility bill. It's a harmless way to manage tight cash flow. I'll just delay it a week. But here's the thing. The IRS sees this behavior very differently. And treating this money like standard business debt, it's a massive trap that catches way too many well-intentioned entrepreneurs. To get you protected, here is our roadmap for today. We'll hit the ultimate compliance deadline, uncover the temporary custodian trap, walk through the failure to deposit timelines, talk about piercing the corporate veil, and finally build out your automated compliance shield. All right, let's jump right into part one, the ultimate compliance deadline and the danger of balancing those endless business dates. When you're running the show and juggling a mountain of operational deadlines, it is so easy to fall into what I call the rookie mindset. That's assuming unpaid payroll taxes are just standard business debt. You figure, I'll take the late fee, use the cash now to keep the lights on, and catch up next month. Well, the IRS reality is completely different. To them, this isn't just a late bill. This is the immediate theft of federal funds. You aren't just paying a bit late. You're literally holding on to money that legally belongs to the United States government. Which leads us perfectly into part two, the temporary custodian trap. Who really owns that withheld cash? Here's the deal. When you process payroll and withhold federal income tax, Social Security, and Medicare from your team's paychecks, that money instantly ceases to belong to your business. The second it leaves your employee's gross pay, ownership transfers. Legally, you become what's called a temporary custodian. You are merely holding those withheld funds on behalf of the government. You're just holding the bucket until the IRS comes to collect it. Think of it like holding a stranger's wallet. Paying your commercial rent with what's inside isn't creative accounting, it's just stealing. And doing that puts you right in the compliance danger zone. The very moment you dip into those withheld funds to, say, cover rent, pay a vendor, or even fund your own owner's draw, you've crossed a major legal line. Even if you fully 100% intend to put that money right back next week when a big client invoice clears, it does not matter. You enter the danger zone the second you use federal funds to float your daily business operations. Okay, on to part three, failure to deposit timelines. Let's look at the escalating costs of missing a deposit. The financial consequences here, they spark instantly, and they're driven by the IRS's terrifying, highly automated enforcement engine. Listen, this isn't some manual process where a friendly agent decides to give you a break because you're a good person. No, it's a rigid mathematical system designed to penalize noncompliance heavily. Days 1 for 14, standard missed deadline penalties start to compound. But hit day 15, and a brutal 10% penalty slams the account. And if they issue a formal notice, that's a flat 15% penalty applied right on top. What started as a quick little cash flow suddenly becomes a crushing financial weight. These failure to deposit penalties scale so aggressively, hitting 10% for payments over 15 days late and jumping to a flat 15% the moment formal notices go out. These percentages will drain your operating accounts incredibly fast. And remember, we're talking about percentages of your aggregate payroll taxes here, so the actual dollar amounts are massive. It rapidly turns a temporary cash flow fix into a massive structural liability for your entire business. Moving right along to part four, piercing the corporate veil. This is exactly when your LLC protections absolutely shatter. So many business owners sleep soundly at night, right? Thinking their S-Corp or their LLC acts as this impenetrable wall against personal ruin. Well, enter Internal Revenue Code Section 6672, the Trust Fund Recovery Penalty. This specific law is the ultimate weapon in the IRS arsenal. It completely shatters your corporate veil, allowing them to bypass those corporate protections entirely and target you personally for unpaid payroll taxes. Under this code, your corporate protections are rendered completely useless. If the IRS initiates enforcement action here, they are coming for you personally as the responsible individual. Your personal bank accounts? Targeted and seized. Your home? Vulnerable to direct liens. Your personal assets can literally be liquidated to recover those stolen funds. They honestly do not care about your LLC charter when trust fund taxes are involved. So how do we fix this? That brings us to part 5, the automated compliance shield. It is time to insulate your personal exposure. Look, hope is not a strategy, and manual reminders on your calendar are absolutely not enough to protect your home and your family's assets. You need what we call the Section 6672 Shield Blueprint. Step 1, end manual tracking systems completely. Just stop doing it. Step 2, integrate an automated software buffer. You want a system that automatically extracts, isolates, and deposits those tax funds every single time you run a pay cycle. Take human error and human temptation entirely out of the equation. The ultimate rule you have to live by is this: maintain absolute separation between your business operating capital and your employee tax funds. Setting up this automated system ensures you close your compliance blind spots entirely. Because let's face it, if you never actually see the money sitting in your main account, you can't accidentally spend it. I want to leave you with a provocative thought here as we wrap up. Are you still tracking payroll taxes manually? And if so, is it really worth risking your personal home for a temporary cash flow fix? Take a hard look at your operations today. Look at the systems you've got in place and ask yourself if clinging to manual payroll tracking is truly worth risking your personal assets and your financial future. Thanks so much for joining me for this Liz Biz Academy Explainer. Take this knowledge, go automate your compliance shield today, and protect everything you've worked so hard to build.